You cut your position in half by the end of the year. We know Apple stock was selling off. So my question is it time to add to your Apple holdings, or is there more downside?
You know, Rhonda, it's not time to add in our opinion. The reason for that is there's really this lull for Apple probably until you get the iPhone 6 out. So we probably have a couple more quarters without any real catalyst behind Apple. And given that it's so overowned, our opinion is that there could be continued pressure on Apple over the near term. Longer term, though, you probably do need to own Apple. It's just a great company, great cash flows. They've created a great ecosystem that will allow that company to do well over the long term.
But the price isn't exactly right just yet.
Well, you know, the stock is a cheap stock, but there could actually be more pressure on earnings going forward. You know, we're estimating about flat earnings for 2013 versus 2012, and that's quite a change for Apple, and that's with, you know, almost about 20% revenue growth. You know, so we would like to see Apple kind of move forward through the year to get closer to actual earnings growth again, and then I think we could get more excited about the name.
I know you're excited about financials. 3 of your top 5 holdings are the big name banks. Financials had a stellar run in 2012. Is there really more upside for this group, or is it time to take some money off the table there?
No, we've actually held with the group, Rhonda. The main reason is these stocks are still cheap. So on a tangible book value, you know, the big companies, Bank of America, Citigroup, they are selling below tangible book value. Their net interest margin is contracting, which is not good, but they are experiencing some loan growth. And we do believe as the global economy continues to heal, that these stocks will continue to move higher and eventually sell above tangible book value levels.
David, how do you see valuations overall? You know, if you read the headlines, you see stocks are near 5-year highs, depending on what day it is. Are they getting stretched?
No, Rhonda, valuations for the market are not getting stretched. The S&P 500 sells at 14.3 times expected 2013 earnings. If you go back to 1926, markets actually average over 15 times earnings. So there's certainly upside from that point of view. Also, in low interest rate, low inflationary environments, which we're currently in, the market could sell at higher valuations. Of course, though, we do have some secular issues like the budget deficit that's not going to allow for that, but certainly valuations could go higher. Just on another note, price to book, the market's also cheap on a price to book value ratio. The only 2 times in the past 20-25 years it sold below that was during the 90-91 recession, financial crisis, and also during 2008, early 2009 Great Recession.